Your mortgage payment just soared from about $1,900 today up to $3,400 tomorrow. Yeah, in 24 hours, that's what's happening to everyday, decent, hard-working people. Let's look at just how awfully bad this unfolding scenario is for so many. Also, let me show you how to ethically profit from something related to this that you probably never seen or had even thought about before. It's some bigger picture context about mortgages that could blow your mind. Also, get more on why I never want to pay off any of my properties. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, best-selling author, and longtime real estate investor. Compared to the world, the US has very little variable rate debt. Now let's compare this over a bunch of more developed world nations. Red signals danger because it means that your property's mortgage interest rate resets to the current market rate every single year. Orange means it resets every 1 to 5 years, so still a little dangerous. Light blue means it's fixed for 5 to 10 years, that's some better stability. And dark blue, that's the best, meaning that your mortgage interest rate is set in concrete and fixed in place for more than 10 years. And second from the bottom, look at all of our dark blue here in the United States, where over 96% of mortgage borrowers have long-term fixed rates, with the majority being for 30 years. France is up there too. Fixed rate is the most common type of home loan there. But in France, 20 years is the most common, meaning that your payments would only be stretched out that long, substantially shorter than on our 30-year loans. Virtually every other place in the world, they can't pull off what you can if you're here in the US like I am. In Canada, the most common mortgage terms reset to the prevailing market interest rate every 5 years. Look at Finland's red bar length. Their mortgages reset every single year or faster. Sheesh, that's more often than some people lose the remote control or rearrange their furniture. Okay, so what does this really mean? Gosh, pour one out for most mortgage borrowers in the rest of the world. Rates have been up internationally, not just in the United States. So they can't lock in their mortgage rate for the long term. Therefore, with rates doubling or tripling since 2021, it stands to ruin some foreign homeowners. What if you're middle class and in some of these nations in the alarming red, like Australia and Finland and Ireland, and your mortgage payment soars from, say, $1,893 on Tuesday up to $3,415 on Wednesday? That's what's happening in some of these places today. For example, The Guardian published this article about how Australia's homeowners are bracing for a mortgage cliff. That's what they call this phenomenon in other parts of the world, a mortgage cliff, paying $15,000 more of their annual income just all going to interest. They're not even getting anything for it. The extra $15K is just gone, evaporated into interest. That breaks a lot of people, and households with just the average Aussie mortgage, they have to somehow come up with another $1,250 per month. Well, here in the US, luckily we don't even know the term mortgage cliff. No one talks about it or uses that term because it's not happening except in the commercial real estate world where their rates often reset. So think about if all of your investment properties had this mortgage cliff effect happen to them too, in addition to your primary residence. I mean, you might go from an income stream to a negative cash flow almost overnight. And in the Mortgage Advantage US, we are safe in residential. For example, here's what we can do if we buy today at, say, an 8% mortgage rate on a 30-year fixed amortizing loan, just the plain vanilla loan. Well, then a few years later, if rates rise to 10%, well, you're happy to be locked in at 8%. And on the other hand, if rates fall to 6% later, you can usually refinance down to that. And note that I refrain from saying just refinance. I hear some people say it that way. Just refinance. I don't like the word just because you can't just push a button and get that. You'll still need hours of your time refining to provide a mortgage loan underwriter with documentation, and you might have your credit score checked, and maybe there's a refi appraisal too, but it is worth it. Think of it this way. When rates fall, as long as you've got the equity cushion, you can legally alter your deal with the bank whenever you want. Tear up your contract that you had with them. You can refi it on them, and you've usually got no prepayment penalty on it either in residential 1 to 4 unit property in the US. So yet if rates rise, the bank cannot alter it on you. They can't tear up your contract, and you've got the sweet mortgage rate that's lower than the prevailing market rate. That's what you do to profit from this, and it's almost an unfair advantage for Americans. So the bottom line there is that unlike most of the world, the US mortgage market is dominated by long-term fixed interest rate debt, and as rates change, you get to play both sides of the game, whatever side works for you. So add smart properties with loans, and in most cases you don't want the 15-year loan, you want the 30, because that way you can increase your cash flow by having the lower mortgage payment, being able to stretch it out for 30 years. Take advantage of that American privilege, if you will. And I think we're all familiar with the amortization schedules that'll show you that you will pay less interest on the 15-year loan, but run the numbers on how you'd reinvest the difference from your 30-year mortgage's lower payment, and then you're probably going to like what you see there. And plus, that way you stay flexible. With a 15-year mortgage, you must make the higher payment. It's also more difficult for income properties to work with a 15-year mortgage payment. It's really going to lower your cash flow. With a 30-year, you have the option to pay extra toward principal, which actually is usually not a wise option, but I'll let you do the math on that one. When you can get it, I actually prefer an interest-only loan type. I think that's typically better than the amortizing 30. Now, wouldn't that mean that your principal balance never gets paid down with an interest-only loan? Yeah, that's exactly the point. I have never owned a paid off property, although I had the ability to pay off many of them and kill their mortgages. I definitely don't want that to happen. If that sounds unusual to you, if you're not sure why interest only is the wise strategy in a lot of cases, even most cases, come along with me. Let me explain it to you. I'll run some numbers and show you. This really gets interesting in this video right here.